Yes, people, right now we're on Morgan Stanley. So let's take a look at this article. So here they're talking about why gold's rally might continue on. So if you have noticed over the last kind of few months and actually throughout this year, gold has been smashing it in terms of rallying in price and it has gone really high. So as of the 24th of October, the gold price right now is at $4,067. So it has gone down basically slightly in the last few days. We have seen it fall. So we did see basically some issues around that after the rally. But investors have been flocking to gold over the last few months. So let's see what's going on Morgan Stanley here. So it says despite this week's tumble, so as mentioned, gold prices have gone down slightly. Gold prices could extend gains as central banks and ETFs buy in anticipating Fed rate cuts and a weaker dollar. So some of the key takeaways here: gold prices, which are up nearly 50% in 2025, are likely to add more gains by the end of 2026. Gold surpassed the share of US Treasuries in the central bank reserves for the first time since 1996, while ETFs backed by gold keep posting record inflows. So, higher prices could dampen demand for gold, with jewelry consumption already showing signs of weakness. A supercycle of capital investments by gold producers is unlikely due to its permitting and regulatory hurdles. Gold broke a new record high on October the 10th, surpassing $4,000 per ounce for the first time. So it was only a few years ago that it was much less than that. So it's pretty much been doubling here in the year 2025 this year, over 50% in growth. Now, it has continued to climb, but then since October 21st, the rally hit a bit of a wall, so it's kind of like eased off a bit. There was a drop of 5-6%, which is one of the biggest falls in the last decade or so more actually. Still, gold has surged about 50% across the 10 months of 2025, cementing its status as one of 2025's top performing assets. Obviously, gold is a precious metal, and other metals like rhodium, palladium, silver have also seen good price increases as investors have been turning towards precious metals with world economies going up and down. So you've seen issues around Donald Trump, the American president's tariffs, and the tariff wars with China and other countries. So a lot of people have lost some confidence in these economies and so on. So people decided to invest in things like precious metals. So we've seen the gold prices rise. The price increases are a reaction to major policy, geopolitical, and economic developments, which I've just mentioned, including tariffs, the Gaza genocide, issues around Federal Reserve independence, and also the US government issues as well. Morgan Stanley Research expects the rally to continue and revised its 2026 gold forecast upward to around 4,400 per ounce. So that's another $400 or so more compared to the price that we're at right now, which is just hovering over the 4,000, the 4K dollar mark. Big increase there. So that'll be another, nice increase there for gold prices in terms of the previous estimates, which were much lower. The new projection implies additional gains of 10% or more are going on into next year. Investors are watching and rubbing their hands because obviously they see gold prices rise. And gold is not just a hedge against inflation, but it's also a barometer for everything from central bank policy to geopolitical risk, says Morgan Stanley's Metal and Mining's commodity strategist Amy Gower. So it says here we see further upside in gold, driven by a falling US dollar, strong ETF buying, continued central bank purchases, and a backdrop of uncertainty supporting demand for the safe haven assets. So people have been using gold for thousands of years, coins as a medium of exchange when they're buying things. Kings have coveted gold, treasure, and so on, because it's one of those valuable precious metals that, have good qualities in terms of long lasting. The shine doesn't go away. And that's why it's become so desired. So, what might be driving the rally potentially, according to this article? So, since 96, gold now accounts for a larger share of central bank reserves. Another kind of phenomenon is a lot of the central banks of different countries, like China and elsewhere, have been, gathering gold, getting gold, and building up their treasuries in terms of gold stocks, gold bars. Also, Russia and other countries as well. Obviously, Russia is under sanctions, so they might be doing it as a medium of, maintaining wealth and so on. But it's a powerful signal of confidence in the metal's long-term value. And like I said, it has been for millennia, thousands of years. Now, a newer thing is exchange traded funds. So these have also been, getting strong buyers of gold, signaling renewed interest from institutional investors. ETFs backed by physical gold posted a record inflow of $26 billion in the third quarter. Their total basically assets under management ended the quarter at $472 billion. Also another record. So records galore here when it comes to gold. And then, even non-professional buyers or retail investors are joining the rush for gold. It's gold mania. Everyone's just seeing gold right now. As markets expect the US dollar to weaken on prospects of slower growth in the world's largest economy, a lot of investors are shifting their safe haven portfolios, traditional kind of investing places, dollar denominated assets, and into transitioning into gold as a more stronger and safer kind of hedge. So additionally, a weaker dollar makes gold more affordable for international buyers. Another boost to gold prices comes from interest rate reductions by the Federal Reserve. Looking back in the 90s, gold prices have risen 6% on average in the 60 days following the start of a Fed rate cutting cycle, as lower yields make it easier for non yielding assets to compete. So, with all these factors, it's probably comes as no surprise that gold is pushing up in the markets in terms of value right now, on top of our order when it comes to the preference among purchasing commodities according to Gower. So there are some risks as well, demand destruction. So let's take a look at this concept. Despite bullish outlook, the rally could face headwinds. So if the US dollar remains stronger, obviously that's going to cause a problem there than expected, or if the Fed holds interest rates steady, gold's momentum might slow down or maybe incrementally. There's also a risk of demand destruction from higher prices. So, for example, as the price of gold climbs higher, central banks will need to purchase less of it to achieve their reserve targets. Another potential negative impact might come from the jewelry market. Now, obviously, jewelry accounts for around about 40% of gold consumption. So, places like India have massive traditions, cultures, and heritage around jewelry as being a medium of kind of maintaining wealth within the family. So, a large percentage of gold jewelry holders reside in the Indian subcontinent, particularly India. Jewelry demand is already showing signs of weakness, though, at the moment, Gower says. Second quarter gold jewelry demand was the worst since the third quarter of 2020 as consumers reacted to higher prices. So, although, jewelry is high in demand, especially in places like India when it comes to dowries for brides and gifts for brides, obviously now that has been for hundreds and hundreds of years. But currently the prices are high, so that might be a reason why the demand is weaker currently for jewelry. But traditionally, obviously, it has been high, especially in areas where gold is part of the cultural makeup of society. Okay, so on the other hand, we have those that dig for gold. So obviously, mining for gold is big, although a lot of the gold in the Earth's kind of surface has come up to the earth and it has been mined, but higher prices are a boost for gold producers, which have increased their mine supply by only 0.3% per year on average since 2018. Some of the producers are presenting feasibility studies for new projects, expanding the life of their existing mines or resuming operations at units previously considered uneconomical. So obviously they're trying to get as much gold as possible out of the ground, even in places where mines might have stopped being functional, but they're even looking at existing mines to try and explore further for more gold. There are several issues there which could lead to project delays, cancellations, difficulties in obtaining environmental and social licenses to operate, local indigenous communities, being affected, uncertainty around royalties and taxes, political governance, macro issues as well as micro issues, and then other elements around politics as well. So the chance of new super cycle of capital expenditure by gold producers are limited according to Morgan Stanley Research. So profitable mining customers might continue to drive the bottlenecking of projects and underpin, capex growth out to the end of the decade, says Michael Harlock, who covers European capital goods at Morgan Stanley Research. A super cycle in the form of a substantial greenfield uptick is unlikely given the permitting and regulatory constraints. However, we have seen gold prices rise this year and since the last few years and that, so we can see how gold is actually becoming one of those precious metals to potentially invest in. Always do your own due diligence when investing in any precious metals or otherwise. Okay, people, let us know what you think about gold in the comment section below. Don't forget to like, share, subscribe. Catch you in the next one.